Good. So welcome you all once again to today's section. Today we'll continue at what we look at the last section or the previous section. Great. We said business valuation. We started with the net asset method. We look at net assets, excluding the goodwill. I'll look at goodwill after when we are done with everything. We look at goodwill. Probably in our next lecture, goodwill will be contained or dealt with. So today we are going to look at earnings yield basis. So earnings yield method. So earnings yield method. So the next method is number 2. Earnings yield method. So let's go up a little. So earnings yield method. Earnings yield method. That is the today's section. Now, according to ratio, what was the formula for earnings yield? What was the formula for earnings yield? Now, anything yield we said is that item over the market price. Anything yield is that item per share over the market price per share. So earnings yield will be, let's shortcut it by saying EY, earnings yield. It's now equal to, we said earnings yield is the earnings per share over the market price per share, because anything yield is that item per share over the market price per share. So it will be earnings per share over the market price per share. That is the earnings yield, basically times 100. Now, under this method, under the earnings yield method, we are going to make the market price the subject. So market price will be, we are making this guy the subject. So if you have done little mathematics, how do you make MP the subject? So as usual, you don't need to go through this process. So I'll tell you that multiple groups are right. That's something like MPS times earnings yield, right? It's now equal to EPS. You multiply both sides by the LCM, that's the MPS. Okay, that's element 2. So you make market price the subject. So therefore, market price will stand alone here. Divide both sides by what? Earnings yield. So it's now equal to earnings per share over earnings yield. Perfect. You don't need to tell the examiner, proof to the examiner how you arrive at this. No, not at all. All what you need to know is this. We are going to make the market price the subject here. Make it the subject so that we can use it to determine the price of the shares. That is it. So I'm going to base on the earnings yield method. Earnings yield method. So let's see. Let's look at the game. Now, we have only 3 steps that we have to go through to get the earnings yield calculated. Only 3 steps. There is a danger. The danger is that we cannot get earnings yield for the unlisted company. And most of the company or most of the question to the valuation will be for unlisted. So you have to go through the 3-step approach. As the name suggests, we have to determine the earnings per share and then the earnings yield. That's all. If we know these 2 items and divide to give you the market price. So let's see the steps. Then we will back it with illustration. The question that we are solving in our previous lecture. Look at that one. So step one, so in calculating the steps. So steps one, calculate the earnings per share to determine the earnings per share of the unlisted company or of the company in question. Calculate the earnings per share of the company in question. So if you are valuing sweet potato, you first calculate the earnings per share. How do you calculate earnings per share? It is a profit after tax or profit available to ordinary dividend divided by the number of shares. So here it will be anti-part. If there's any preference dividend, you less it. So minus preference dividend. That is irredeemable preference dividend. Irredeemable preference dividend. The dividend that we are interested in is irredeemable, not the redeemable. Good. All divided by the number of what shares. So number of shares. That's the very first step that we have to look at for. You calculate it. If you do have irredeemable preference dividend in your question, you bring it. If there's no original preference dividend, you leave it like that. Then that is all. Okay. Then step two. There are only 3 steps approach. Step two. Step two. Calculate the earnings yield. You calculate the earnings yield for similar but listed company. That is good. So earnings yield for similar but what must be a listed company. Listed company. Why? Because the unlisted company will not get earnings yield because the market price per share will not be determined, will not be easily known. So we cannot get the earnings yield. So look for that company. So sweet potato. Look for a competitor. Let's say yam or cocoyam. They are in the same industry. Then calculate the earnings per share for that of that company divided by the market price. You get the earnings yield. So first get the earnings yield for similar but listed company. Then you scale it up. You scale it up. Then scale it up. So that's A. B. Scale it up. So risk it up. And then assume a risk factor. So assume a risk factor. So you scale it up. Scale up. Up. Great. If we scale it up, we'll look at it. Because 2 companies, let's ask this question. If you have 2 companies, listed company and unlisted company, so these 2 companies, tell me, listed or unlisted, which one will be more riskier or the risk level? So which one will have higher risks and then low risks? So let's see. So in general, all other things being equal, unlisted company have higher risks. The risk involved is higher than that of the listed company. Good. It means that there was some sort of security attached to a listed company, unlike that of the unlisted. Why? Because listed company will be regulated by the stock market. If you're an investor and you have shares in the listed company, Easily, you can sell off your shares and then move on with a different company. But if you're a listed company, you can't trade your shares publicly. Yes. So it means that all other things being equal, the unlisted company is more risky than that of the listed company. So it's highly in terms of risks. The risk involved that of the unlisted is higher than that of the listed company. So if you have calculated earnings yield for similar but listed company, all of them will not be at the same path. You have to assume a risk factor. You have to assume what? A risk factor. So assume that this unlisted company that I'm going to use for, if the earnings yield that you have calculated, let's assume that you have, let's say, 25. You have 25 for the earnings yield. Then you assume a risk factor. Sometimes the examiner might indicate the risk factor for you. If not, select your own. So tell the examiner that, oh, usually unlisted company will be, let's say, 20% riskier than a listed company. So we say scale it up. So scale the risk factor up. So assume a risk factor and scale it up. So it means that if a listed company is getting 25 as a PE ratio, unlisted company must get more than that. That's the meaning of the scale up. So here I'll just tell the examiner that if there's risk factor is 20%, then I say 1.2 times 25. Then I'll get, or just go by this 25 risk. The risk is 20%. So find 20% of the 25. And that will probably give us what? 5, right? Good. If it is 5, you add, then you get 30. Perfect. Which is the same as what? You multiplying the 1.2 by the 25, which is to give you the 30. That is the scale up. We are done. Let's go to the step 3 because it's a 3-step approach. So step 3, you now calculate the earnings yield for the unlisted company or the company in question. You now calculate the market price, not the earnings yield. The market price for the unlisted company, which is equal to earnings per share divided by that of the earnings yield. So that's step 1 divided by step 2. Step 1 divided by step 2. Then you are done. So step 1 divided by step 2. So that's the step that we are going to go through to calculate the market price. In fact, anywhere you meet something yield, you're using the yield to calculate the market price. These are the 3 steps that you have to go through. So you bound meet it again. Okay, so we are done. Now let's back with what illustration, this 3 method using sweet potato. So let's go to sweet potato. Sweet potato. So that question is in sweet potato. The question that we were looking at the last time. Sweet potato. So for sweet potato, you're going to calculate the market price per share using what? The earnings yield method. For the earnings yield method. Okay, so for the earnings yield method. So have you seen why they have given us YAM Limited, a competitor listed on Ghana Stock Exchange? So it's a similar company in the same industry, but what? Listed. So that is it. So let's start with the steps. You follow the steps. We are finding the market price per share using what? Earnings yield method. So let's go up a little. That is another that. We are looking You are using the earnings yield method. So step one, after the examiner, the earnings per share for that of sweet potato. So earnings per share in bracket sweet potato, the company in question, not the competitor. So sweet potato, which is equal to the profit after tax. The more I write the formula, the more I remember. Minus irredeemable preference dividend, all divided by number of shares. All divided by number of what? Shares. Good. All divided by number of shares. Okay. Okay, so let's go and pick it. Profit after tax minus irredeemable preference shares. The dividend on irredeemable preference shares. So the profit after tax for sweet potato to be in the profit and loss statement. So profit after tax is there. 28,500. You check the question. If they have irredeemable preference dividend. I think we saw something like that. There's irredeemable preference dividend. So you have to calculate the irredeemable preference dividend ourselves. That will be 22% on the 20,000. That is the irredeemable preference dividend. Why do we subtract? We subtract because that one is part of equity and it has not been subtracted in the profit after tax. So that's why we are taking it off. So that is it. So first, profit after tax 28,400. Let's go and pick that one. 28,500. Perfect. This by one. There's be 28,500 minus all divided by the number of shares. Then we go and pick the irredeemable preference dividend. If there's no irredeemable preference dividend, just pick the profit after tax, divide by number of shares. Check note. So you just have to pick the profit after tax, divide by number of shares. You only pick or bring irredeemable preference shares if you have irredeemable preference shares in the question. And indeed here we have. So here's it. That will be 22% times 20,000. That will be 4,400. So minus 22% times 20,000. Then all divided by number of shares. Sweet potato, how many shares they have? Our last meeting, we realized it. We calculated it and then we had what? Well, we had 400,000 shares. Good, so that's the earnings per share. So this will give us 0.06. So that's the first step we have to do. Okay, so let's go to the next step. Step 2. We need the earnings yield of what? Of a key competitor. Yeah, the question of identifying them. Because they're in the same industry as the sweet potato. So to get earnings yield, We said that anything yield is that item per share over the market price per share. So earnings yield is nothing by earnings per share over what market price per share of the company. So this is equal to earnings per share over the market price per share. Earnings per share and market price per share. Now let's look at the substitution. So let's go and pick the details of YAM Limited. So we need to get the earnings per share and then the market price of this competitor. So they are saying YAM Limited is a competitor listed on Ghana Stock Exchange. Extract is below. So now let's see. Market capitalization is 2 million. Market capitalization simply means their total market value. How many shares? They do have. Okay, they do have 20,000 shares. So the market capitalization will be the total market value of the entire business. Then the number of shares, 800,000. So what will be the share price? If the market capitalization or that company, their market value is 2 million, then the number of shares is 800,000. So what will be the share price? So it means that the market capitalization is 250 pesos. That's the market price of the company. The market price is 250 pesos. How? Is the 2 million divided by what? 800,000. The 2 million divided by 800,000. Perfect. Great. So now let's continue with the game. Now, earnings per share has been given to us. If you divide this one by this, you get a market price per share. Earnings per share is here, 20 pesos. So if I divide the earnings per share by the market price, it should give me the earnings yield for the competitor. That's for YAM. So let's look at that. That is for YAM. Okay, so let's calculate the earnings yield. Now we're able to calculate the earnings per share. So earnings per share here, I've done it for us already, 0.2 or 0.02. Earnings per share will be earnings per share is 0.2. So 0.2 divided by the market price of the shares, which is what? 250 pesos to 2.5. How do you get the 2.5? We calculated the market price per share by dividing the 2 million by the 800,000. That will give us the market price per share. So the final answer of this, that is the earnings yield. So we say get the earnings yield for a similar competitor, but a similar company but listed. Similar but listed company. So now you got it. Then B, scale it up. So here let's assume a risk factor. Please, if they don't give you the risk factor, you can assume any figure of your choice. So let's assume the risk factor. So take this section off, then we are done. So let me take this section off. These are the steps. If you are following the steps to get the earnings yield. So the risk factor will be, so let the risk factor be 20%. Any percentage, maybe from 0 up to just up to, let's say from 5%, maybe up to 40%. Can select any. And here we scale apples. So here we are saying that unlisted company sweet potato will be 20% riskier than listed company yam. This calculation is for yam. You have to assume the risk factor. But before that, I need someone to give me the answer. This answer then is used. It's not written it. Then it's yield. Good. So what do you get for the yield? So to be the, so get 0.08 to 0.08. That's the risk factor. So that's the earnings yield for a listed company. Yam. Yam is a listed company. And once Yam is a listed company, we have to assume a risk factor. We have to assume that Yam will by always be less in terms of risk than that of the sweet potato. Or sweet potato will be 20% riskier than that of Yam. So it means that you have to scale this one up. So convert the percentage that you guessed for yourself, which is 20%, convert to decimal, 0.2, add it to 1. So therefore, the earnings yield for sweet potato, the company under observation will be, just convert it to 1.2 times the 0.8, and that will give us, that is the earnings yield for that of sweet potato. So we scale it up, then we get the earnings yield. So this is 0.08. Okay. So it gets 0.96. Perfect. I'll take that. So 0.96. So now it means that the earnings yield equivalent to that of sweet potato will be this. So therefore, the market price of sweet potato shares should be the earnings per share that we calculated, that's 0.06. So 0.06 divided by that of the earnings yield of 0.96. Or if you like, we can now code the formula first, because the more I code the formula, the more I remember. Then we'll tell the examiner that market price of the share is nothing by the earnings per share over the earnings yield. Then we'll do substitution. Great. But it should be 0.096. Perfect. Then what do? We do substitution. Earnings per share for the company in question, we had 0.06. So that would be 0.06, all divided by the earnings yield. Similar one, we had 0.096. So this is 0.096. So therefore, what will be the market price? Perfect. Then that's end of the game. So the market price per share will be 0.625. Yes. For that of the net asset method, we had 0.761 or so. Yeah, 761. That was in our last meeting. Okay. So perfect. So that is the calculation of what the market price per share value in business using the earnings yield method. Yeah, then move on to the next method. Great. So now we are moving on to the next one using, in fact, when you pick the earnings yield method, what we've done, it will be equivalent or to be the same as the dividend yield method. So there's the dividend yield method. When I get to dividend yield method, the same steps must be followed. So take note. So when you get there, then fine. Let's move on to the next step as the price earning ratio, using the PE ratio to look for, to value the company. So we're going through the methods of valuing company. We've looked at two so far. I'm going to look at the third one. Number 3. We look at price earning ratio. Price earning ratio. We normally call it PE ratio. We're using the PE ratio. As the name suggests, PE ratio, the formula will be, the PE ratio is equal to market price of the shares all divided by that of the earnings per share. This is a PE ratio. Now, with this, make the market price the subject. What do you get? If you want to make the market price the subject, you multiply it by the EPS. So multiply it by EPS, sometimes EPS. This one cancels this one away. So therefore, EPS times the PE ratio should give us the market price per share. So in short, here we are saying that the market price of the shares is nothing but your earnings per share times the PE ratio. That's all. You don't need to prove to the examiner how you arrive at this formula. No. All what we are interested in is you quote the market price per share is nothing but the earnings per share times the PE ratio. How we arrive at it is not part of the question. It's not part of the examination. Good. So take note. Okay. So here we are saying that the market price of the company shares nothing by the PE ratio times earnings per share. So down to 3 steps. Step 1, cover the earnings per share for the company in question. Step 2, cover the PE ratio for similar, so PE ratio. Again, for a similar but listed company, so similar but what listed. company. Then after getting it, that's A, to B. You scale it down. So assume a risk factor and scale it what? Down. To scale down what? To scale it down. So for instance, if you are assuming that the risk factor is 20%, or the scale it down means you take net of it, you take 80%. Yeah, you take 80% of what you have calculated because of the risk factor. So basically, that is it. Okay. Then step 3. You now calculate what? The market price per share, which is equal to, the answer is step 1, which is the earnings per share, times the answer is step 2, which is the PE ratio of the B, the one that you scale down. And that's the end of the game. So let's go back with what? Illustration on the other side. So I'll start using the same question. Sweet potato. The question is called sweet potato. Good. So we are using the question. So PE ratio. So number 3. So price earning ratio. So based on PE ratio. With the first step, get the earnings per share. Done it already in the earnings yield method. We will still do it. So that the earnings per share is equal to my profit after tax minus irredeemable preference dividend, if it's in the question. If there's no irredeemable preference dividend, I just have to divide the profit after tax by the number of what? Shares. So this gives us profit after tax of 28,500 minus 22% of 20,000. I think it was 4,400 or so. Yes. It was 4,400. So we can bring it to 4,400. All divided by number of shares. The number of shares was 400,000. So I guess we had 0.06. 0.06. Yes, that was the answer that we had. So the same step. Step 2, we shall calculate what? The PE ratio for similar company. So calculate the PE ratio, price earning ratio. So PE ratio for a similar. Here for YAM, if identify YAM to be the similar company. YAM to be the similar company. So they identify YAM to be the similar company. Then what did you do again? We know that PE ratio is nothing by the market price of that company all over the earnings per share. And I want to look at all of this. The market price of YAM Limited, we have calculated it already to be what? Let's go and then pick it again. YAM, where are you? So market price per share, we said is the market capitalization. Their total market value is 2 million. If they have 800,000 shares, then what will be the market price per share? So the entire market value of the shares is 2 million. Then each share will be what? That's 2 million over 800. And we have 2.5. Earnings per share is given to us to be what? 0.2. So it's just the inverse of the earnings yield, which is equal to 2.5 all divided by 0.2. And this will give us a price earning ratio of, okay, so it's 12.5. That's the PE ratio. Then you assume a risk factor. So a risk factor of, so I'm assuming the same 20%. Yes. Then you scale it what? Down. So if the risk factor is 20%, then the earning must be reduced. So we scale it down. So that will be into bracket. So therefore, the P ratio for that of sweet potato, the company in question will be 80% times 4.5. Now give us 80% times 12.5. Okay, so we have scaled it down. Get 10 points. So the answer will be 10. Now we are done. The answer is 10. So we can now go ahead and now we go to step 3. So step 1, step 2, step 3. Step 3, just the two answers. Final answer step 1 times final answer step 2. That is all. Okay. So let's do it here. So you go to 3. The market price per share. Market price per share will be equal to the more remember earnings per share that is calculated times the PE ratio, which is equal to earnings per share of 0.06 times 10, and that gives us 0.6 per share. That's the final answer. If you like, that is another Gamma City like this, then we are done. Okay. Okay, so we can continue the game. This is the PE ratio, price earning ratio. Great. This one is similar, like the steps. P ratio of a similar entity or company, but listed. Good. If they don't give you a listed company and they give you unlisted, still because they've not given you, they just pick it. Sometimes they pick it from the newspaper, not true information. So you still assume a risk factor. So that is it. Now the next one is the dividend yield method. So let's go to dividend yield. How to use dividend yield to appraise the project. How to use dividend yield. Now I want to follow the 3 steps approach. But these formulas, they are just the same. They are just one now, we are turning them upside down. So you just have to maintain the steps. So we are on the number 4. Dividend yield method. With the dividend yield method, as the name suggests, anything yield is that item per share over the market price per share. So dividend yield is equal to dividend per share over the market price per share, MPS. Here you have to make market price the subject. So therefore, under this method, the market price is nothing but the dividend per share over the dividend yield. So that's the formula. How we calculated the earnings yield It's the same thing here. Just that anyway you saw earnings yield, can you replace it by dividend yield or dividend? That's all. Anyway you saw earnings, replace it by dividend. Great. So let's quickly look at the steps. It's still the same under the earnings yield method. So the steps in here will be 3-step approach. Don't let your step be more than 3. Step 1, calculate what you call over there it was earnings per share. Here to be dividend per share. So determine the dividend per share, which is equal to total. Here it must be ordinary dividend divided by number of shares. Step 2, get the dividend yield of a similar company. Dividend yield of what? Into brackets, similar company, but must be a listed company. Then here too is a yield. So you scale the risks, then you assume risks. How do you get the dividend yield for that similar company? The dividend yield is equal to the dividend per share of the company divided by what? The market price per share. Then this is the A. B, you scale it what? Upwards. So scale upwards with the risk factor. Scale up. Then you go to 3. Now you calculate the market price per share. The market price per share is equal to the final answer at the B. Then this. So that's the dividend per share. That's the step 1. All divided by market price per share. Good. So that is it. So great. And so let's back it with what illustration of that one here. Value here. Nice. So step 1, we're looking for dividend yield method. No shortcut. Step 1, just calculate the dividend for the company in question. So let's go to the company in question. That's sweet potato. Sweet potato. Let's calculate the dividend yield for that's the dividend per share. We say the total dividend all divided by number of shares. So what's the sweet potato? So let's go to sweet potatoes. Check the income surplus of sweet potato. That's what you see. So you go to the change in equity, income surplus section. Open balance is there. Profit for the year. That's profit after tax less dividend. So the dividend is what? 12,400 divided by the number of shares. You are done. That's the step 1. So that's step 1. So dividend per share for sweet potato will be 12,400 divided by 400,000. And that is the number of shares. Number of shares 400,000. So what would be the answer? So the answer will be so the dividend must be ordinary dividend, not preference dividend. So take notes. So that's 0.031. We are no, we're not done. Let's go to step 2. So calculate the dividend yield for what? Similar company, but listed. In this question, Yam has been identified to be the similar company. All of them are in the same industry. Sweet potato, yam, cocoa yam. All of them are in what? The same industry. Oh yes. And cassava, the same industry. So let's see. So dividend yield here for who? Yam. Similar company, but listed. How do you find dividend yield? The more I put the formula, the more I remember. Dividend yield, we said that anything yield is nothing by that item per share. So that will be dividend per share of yam divided by the market price per share of yam. That is all. So let's get the dividend. Then let's get the market price. We know the market price already to be 2.5. So the dividend per share for yam. Let's go to the footnote. Yam was given. Great. They say dividend payout ratio. Okay, so if they have made the earnings of 20 pesos per share, what will be the dividend? They say for every 100 Ghana cedi earnings per share that they had, they will pay out 80%. So the dividend payout is what? 80%. So what will be the dividend per share? So when they give the payout, just multiply the payout by what? The earnings per share. It will give you the dividend per share. Perfect. Good. Then the market price, you have calculated it to be the market capitalization over the number of what? Ordinary shares, which was the 2.5 that we had. So the dividend per share is what? The payout ratio, which is the 80% times 20 pesos. That's all. That is what? All. We can also give the retention, proportion of the dividend proportion of the earnings that they've retained. Here they've retained 20%, they pay out what? 80%. So yeah, dividend per share is nothing by, let me do it here. 80% times 0.2 or divided by 2.5. Answer will be, so that will give us 0.064. So it's equal to, let me write it here, 0.064. Now, as usual, because yam limited is enlisted, sweet potato is unlisted, we cannot use this. So we have to scale it what? Up. Assume a risk factor. And please let your risk factor run through all of them. So I've assumed a risk factor of what? 20%. So here we assume that sweet potato. So let's sweet potato be risky by 20%. So by 20%. So that's the risk factor. Or let's, so by 20%. So therefore we scale it up. For that 20%, if I write it there to go to, I like to put it 20%. Okay. Doesn't come. Go in there, 20%. Then therefore the dividend yield for sweet potato will be, for a sweet potato, 1.2. All the yield scale up, P ratio scale down. All the yield scale up, P ratio scale down. So it has to be a ringing tone. Before you enter into the exams, be singing it. So before you enter into the exam, be singing it. So all the earnings you scale up, P ratio scale down, up and down, up and down. That's done. Times 0.064. And now give us okay, so that will be 0.064 0.0768. Finally, calculate the market price per share by what? Dividing the dividend per share by for here, right, market price per share, which is total wrong. By the dividend yield. Yes, in the step. G. So let's go down small. Up and down. Small one. Okay, that's fine. Let's go. Let's have some space. Ow, what help us? Okay, so step 3 is a market price per share. I wanted to quote the formula, but I don't have space, so I won't quote the formula. So the formula is this one. You can quote it there for me. This is the formula. You can quote it there for me. Dividend per share, which is step 1, divided by dividend yield, which is step 2. So it's equal to 0.031 or divided by that is the 0.0768. Okay. So 0.0768. We are done. And that will give us a price of Ghana cedi of 0.something. 0.6 something. Can you check how you get this answer for me? Not this answer. Sorry. That is correct. So finally, the answer is 0.4. Finally. 0.4. So we are done with that of dividend yield method. Let's go to the last method, discounted cash flow techniques. Discounted cash flow techniques. Then that is the end of the game. We will look at a past question or a dividend section. So time. Great. So we can add I think 4.3 to it, but 0.403. Good. But still basically it's 3.6. Then let's make it 4. Yeah, so let's run it to be 4. So 0.404. That's it. 0.404. Okay, so we can move on. Let's go to the last method, discounted cash flow techniques. Discounted cash flow techniques. Now let's look at the discounted cash flow techniques. Now when we look at it in our previous meeting, so we are just marking it with illustration. Now for the discounted cash flow technique, that's the fifth one that we are doing. Discounted cash flow. Discounted cash flow. Now you get a cash flow, then you discount it. Here should be the operating cash flow. Operating what? Cash flow. Operating cash flow before interest and tax. By operating cash flow. Take note, we are looking for cash flow, not profit. It's cash flow before interest and tax. So if you check the IA7 statement of cash flow, we look at it something like that. Yes, that's what they're looking for. If they are giving you profit, what do? They are giving you profit. Don't worry. Add back the depreciation to it to get a cash version. That is all. The underlying word is cash flow, not profit flow. It's a cash flow, not profit flow. Okay. So, and then you discount it. That's all. So discount the cash flow. So let's look at this question and see how best we can do justice to it. And here, one thing about this, if you are looking for, or if you are valuing the company as at 31st December 2010, you need cash flow 1 year from now. So you have to pick cash flow from 2011 onwards. Do not include cash flow of 2010. No. For that day, no. Pick cash that will be generated after 1 year from today. So check this one very careful. Yes. So that is it. So we are doing the valuation when, let's go and see the financial statement date. 31st December 2010. So I will pick cash flows 1 year from now. I will not include 2010's cash flow. No. So I have to include 31st December 2011 from that year going. So if you check note 4, they say profit forecast for the next 5 years as follows. We didn't say discounted profit flow. We said discounted cash flow. So what do? We have to now convert this profit to a cash flow. It means that depreciation has been subtracted. So what do? We add back. So the estimated profit before tax figures are arrived at after charging the estimated depreciation. So what do? Add back. Then discount it. What the cost of capital? The company cost of capital is what? 18%. You can calculate it, or they have given it to us. And I believe strongly that you calculate it for me. Good. So let's go to the board. Then let's pair this question. Our table will look like this. So we start with the year. We start from year 2011, 12, 13, 14, and 15. 1, 2, 3, 4, 5. Yes, 5 years. I'll start with the profit. I'll add back the depreciation and get my cash flow. That's what I want. So cash flow, my discount factor, and get what? The present value. Discount factor is at 18%. So I normally write them beside them so that I won't go and then forecast a different discount factors. Okay. So let's go to the question and pick the profit from the question. So if you do have it there, year 1, the profit was 28,000. Ghana cedi, Ghana cedi, Ghana cedi, Ghana cedi. 28,800, 29,800. You have 32,000. You have 35,000. It should be 38,500. 38,500. 39,600. Then 43,100. Depreciation, let's add back all the depreciations. Depreciation for the first year is 2,200. 2450. 3100. 4050. 4260. So that is it. So what will be the cash flow? We are adding back, we are reversing it, what they've done. Okay. Okay, so 3,200 plus 29,200. That will give us 1,000, 30,000. So that's 32,000. And then 32,000 plus 2,450. That gives us 34,450. So 3,450. Can you confirm any of them? Not true. So 3,450. And this one give us 600. 41,600, right? Okay. 4050. 4050. So that's 43,650. 43,650. 4260. So 4260 will be 47,360. So 47,360. Great. Can you confirm if any of them is wrong? Kindly let me know. 47. Now let's go to the discount factors. I believe strongly from our previous interaction, how to discount the cash flow is not a big deal. So discount factors, let me go and then pick them from the question. Once available, I'll pick them from the question. I have to pick the discount factor, not annuity factor. So this one's good. You can also calculate them. Year one will be 0.847. Year two will be 0.718. 0.609. 0.516. And finally 0.437. So we do the computation. One is 27,104. So 27,104. That's for year one. Now let me show you my case. Okay. Let's go to year two. Great. Year two, you have 24,735. 24,735. Let's go to year four. Year four, we have 22,523. Okay. So year three, 25,334. 25,334. And this. Year four, two, we have 22,523. 22,523. And then can we add all of them? So by the time I go to the last year, we have the answer there, then we are done with the game. Year five, we had 26. The cash flow is 37, right? For 2012. 2012, not 41,600. 2012. So the last year will be 20,696. Can you sum all of them up for me? All of them summing up will be 120,392. Perfect. So let's go down a little. Let's go this way. So 120,390. 120,390. That is the total value. But here we are looking for the value per share. So therefore, value per share will be, that's the benito. This is not part of the calculation. Like it's not part of this table. It's on its own. So value per share will be equal to this value 120,392 divided by the number of shares, which is 400. We are done. So the answer will be, you can write it here. So the price per share will be 120,000 divided by 400. That will give us a 120,392 divided by 400,123. That's 30. 0.3 01, 301, right? Or 30, 30. So 0 dot, so let's bring the Ghana city. 0.301 if possible. So that is the end of the game. So it's calculated all under each method. Great. Unfortunately for us, this is how far a good Lord will bring us. And I know we'll end here. Thank you very much for watching. Please and please, if you have not subscribed, kindly subscribe to the channel for us. Yes, if you have not done that. Great. And thank you once again for doing the watching.